US debt as a percent of GDP is almost at 100%, and the fiscal deficit as a percent of GDP is currently running at around 7%. And that's an all-time record for the United States. Now, as a result of these very high levels of debts and deficits as a percent of GDP, a lot of market participants have become very concerned. And one of the areas where this concern is being exhibited most clearly is in an area of the market called credit default swaps. Now, the spreads on these credit default swaps have risen to levels that are actually quite concerning. They're levels that imply that the official ratings by the official rating agencies on US debt are actually or should be a lot lower than they actually are right now. And in this video, we're going to discuss the implications of what this means that credit default spreads are implying much lower credit ratings for US debt. Now, on this graph that I'm showing you on the screen right now, you can actually see that if you do a regression analysis where you take the credit default spreads that are currently being priced in the market right now, and you regress that against the credit ratings of various countries around the world, it actually suggests that the credit rating of the United States, rather than being AA, should actually be BBB, which is actually just one step above investment grade. Now, for the United States to lose its investment grade credit rating would be absolutely disastrous. Now, I don't think that the United States is going to lose its investment grade credit rating anytime very soon, but this is a warning signal. And let's just talk a little bit more about what this means that the credit default swap market is pricing CDS spreads at this level. Just to give you an idea, investors right now are paying up for credit default spreads. In other words, this is kind of an insurance premium that investors pay to protect themselves against a potential default. People are paying more for insurance, this type of insurance, against US debt than they're paying for the debt of Portugal. They're paying more for this than they're paying for the debt of France. Investors are paying a higher premium for this sort of insurance than they're paying for the sovereign debt of Spain. And right now, essentially, US debt is trading at a level in terms of its CDS spreads that are comparable to Italy and also very comparable to Greece. Remember that just a few years ago, Greece was on the verge of a debt default. And the United States CDS right now is trading at a level that's actually pretty comparable to that of Greece. So the market is concerned, and this isn't just a fluke. The CDS market is not the only place in financial markets that it is expressing a lot of worry about the US fiscal situation. For example, real interest rates in the United States, and especially if we compare them to real interest rates for most other developed nations in Europe and Japan, for example, are very, very high. That means that the cost of capital in the United States is very high. And one of the reasons it's high is because the United States is running very, very high fiscal deficits and very high debt in relation to GDP. Concerns about US debt and deficits are being expressed in the foreign exchange market. Recently, the US dollar has declined radically compared to the currencies of most developed nations because a lot of people are worried that the debt is so high and the deficit is so high that eventually the United States is going to have to inflate its way out of its debt. So as a result, the US dollar is actually falling relative to other currencies. Another place that these worries are being reflected is in the gold market. Gold has shot up and is in a historic bull market right now that has taken the purchasing power of gold to a record high. And when I mean record high, I mean really a record high. This is a record high in terms of purchasing power that has gotten above where it was during the big bull market of the 70s and 80s. And it's the highest level of purchasing power in the history of gold going back to the year 1600 at least. That's basically as far back as we have reliable records. So what this means is that gold is pricing in a lot of future inflation right now. It's one of these markets that's expressing a lot of concern about what's happening with the US fiscal situation. Now, another market that's also expressing the same type of concern about the US fiscal situation is Bitcoin. One of the main reasons that people are always saying that you should buy Bitcoin is because supposedly US debt is so high and the fiscal deficit is so high that the US is eventually going to have to inflate its way out of its debt. And so people say that you should buy Bitcoin as a result of that. And as a result of that narrative, Bitcoin has climbed to record highs in recent days. So as you can see, not only is the CDS market expressing a lot of concern about the fiscal situation in the United States, concern about the value of US debt securities, about the value of the US dollar, there's several other markets where this concern is being expressed. Now, one market where this concern is not being expressed right now is in the US equity market. And this is really interesting because when you look at something called the equity premium, which basically reflects the amount of risk that's being priced into the equity market plus expectations of growth. Right now, US equity investors are pricing in the lowest amount of risk that has been priced into the US market almost ever, and some of the highest rates of growth that have also ever been priced in the market. In other words, the equity market is wildly optimistic right now and is very complacent about risk. And that is in complete contradiction to what's happening in the gold market, Bitcoin market, the currency markets, and in the debt markets, interest rate markets, and in CDS. It's a big contradiction. So it's very important that you understand on which side of this debate you're at. Because if these markets that I've been talking about that are expressing concern are actually right about this situation, then you really should have a very, very low allocation to US equities. Now, what if you don't think that this is a big deal? Well, the reality is that equities are already pricing in an extremely optimistic scenario. So you don't really have that much upside in US equities, even if you happen to not be worried about the fiscal debt and deficit situation. Now, I really want you to sign up to my channel because in my next video, I'm actually going to talk in detail about how sustainable the US debt and deficit situation really is. There's a lot of myths about this, big time myths. A lot of people think that the United States is about to head into a crisis right away, that the United States has gone sort of beyond the point of no return, that a crisis is inevitable. And in my next video, I'm actually going to tone down all that rhetoric, and I'm actually going to show you facts and math, and I'm going to show you objective data that's going to enable you to really see for yourself whether and to what extent the US fiscal situation is actually sustainable and for how long it's sustainable. Specifically, we're going to go into things like how high can the US debt as a percent of GDP be before the United States gets into real big trouble? And for how long can the United States continue to run fiscal deficits as it has been before it gets into trouble? We're going to talk about these things actually very, very specifically. And there's very few things that are more important for you as an investor than to understand this. Now, why do I say that? The US Treasury market is the foundation. It's the base layer of the entire US financial system. The US Treasury market is the base upon which everything in US financial markets is built off of. And therefore, this is also the foundation for the entire global financial market. That's how important this situation is. In other words, if you're an investor and you don't understand the sustainability of US debt and deficits, if you're in the dark about this, then you shouldn't be investing at all because there's no issue that's actually more important right now. What I can tell you is that there's a tremendous amount of misinformation on both sides. Some people will say debt and deficits don't matter, and they're wrong. But there's also other people that say that this situation is so out of control and it's so huge that there's absolutely no way that the US can get out of this situation. And these people are also wrong. The issue is that you hardly ever get anywhere in the financial media or anywhere else, somewhere where these issues are quantified, where you can have an objective basis for actually tracking these developments and understanding what you should be doing as an investor. Now, in my own portfolios, and I have two portfolios that I share with my customers in two separate services, we really look at these issues deeply and we take them into account when we're making investments. Now, these issues weren't actually very important in the past because the United States didn't have a debt to GDP ratio that was all that high that you needed to be worried about this, and it didn't have a fiscal deficit as a percent of GDP that was all that high. But right now it does, and it's actually threatening the foundation of the global financial system. So this is something that we're going to have to be taking into account from now until many years in the future. And so I have one service called the Crisis Opportunity Portfolio, which very aggressively attempts to take advantage of major movements that happen in the market when things like the bond market starts to crash, interest rates start to go up, in part as a result of the fact that people are concerned about the US fiscal debt situation. And the reality is that markets are much more fragile right now. They're much more sensitive precisely because we have this fiscal deficit and fiscal debt situations. Any little thing that happens in the world is going to have a much bigger impact because the United States is more vulnerable as a result of this debt and deficit situation. Then I have another service that is a lot more conservative and it's more appropriate for most people. And I offer it on the Seeking Alpha marketplace. And this service is called Successful Portfolio Strategy. In Successful Portfolio Strategy, we also take into account this brand new fiscal situation, this brand new world that we're living in structuring our portfolio and our investments. You can't structure your portfolio and investments the way you did in the 90s and in the last 20 years. It's a completely different ballgame right now. And one of the reasons it's a completely different ballgame is because of this fiscal debt and deficit situation. And we have a very unique understanding of this. And you'll be able to see this when you look at my writings on Seeking Alpha, when you look at my videos, when you look at my service, you'll actually see that the depth of understanding that we have of the fiscal debt and deficit dynamics is unlike anything that you're going to actually see in any other investment services. So we're confident that you're going to find a lot of value being added to your investment process by learning about these issues through my services. So I really encourage you to check that out. And I also really encourage you, again, to subscribe to my channel, because my next couple of videos are actually going to go into great depth in teaching you exactly how much debt the United States can afford to continue to pile up and for how long it can continue to do it. And it's actually going to very specifically look at potential solutions. In other words, what would it take to actually turn this situation around? How impossible is it to turn this situation around? And we're going to actually quantify this. So until then, thank you very much for joining me.